Thanks so much for being here and for being interested. I obviously want to talk about how to build a portfolio for this metals moment, which of course starts with what is this metals moment, right? We have to figure out where we are before we can decide how we think we should position for it. So I will go through this. There's been so much conversation about these topics today by all kinds of astute individuals. Hopefully I'm not repeating anything that has been covered too in depth, but obviously the question that needs to be answered, the overhanging issue is the recession, right? The thing that I really want, and traders of late have been trying to create, assuming it will be a soft landing, right? That's certainly what the broad markets have been doing. But the data are very mixed. The thing that I really like to emphasize here, I really want us to think about that middle chart there. This is the most predicted recession ever, right? Like everybody has been talking about this recession for a very long time. And I think it's really important to hold on to that thought because markets are always forward looking, right? We don't wait until the recession's happened or happening. Markets try and price things in ahead of time. That's why if you try to lock in a fixed rate mortgage, a couple months ago, you were paying so much more than variable because markets are forward looking, right? So the fact that this is a very predicted recession matters because a lot of it has already been priced in. That matters really for gold and where I think it's going in the near term, and probably also matters for the base metals, which are certainly very sensitive to growth. Now, the data on the recession question are very mixed. I'm not going to spend a lot of time on this because I'm sure you are all paying attention to the same sorts of things, which is that, anytime you start to look, any day that you look for data, you can find points for a hard landing and points for a soft landing. And a lot of it, the soft data is going one way and the hard data is going the other way. But, some of the really hard data, the classic signs for recessions, are very clear on this question, right? All the major important yield curves are inverted, and that, is usually a reliable one. You certainly have the World Bank when it cut its global GDP growth forecast to 1.7. That was down from 3%, their forecast from just 6 months ago, right? That's a pretty significant downgrade to cut it almost in half. The fact that we have a double contraction in the services and manufacturing ISM surveys, also the services contraction drop into negative, which is below 50 territory, was somewhat unexpected and happened very sharply. Again, another hard data point that is not happy making. And the chart on the bottom left there, earnings per share forecasts are being cut at a rate that has always preceded a recession. So a lot of these hard indicators are sending a fairly clear message. But when I say the data is very mixed, it's because there's also a lot of other indicators that are suggesting that things aren't actually all that bad, right? So obviously inflation's coming down. That has been the thing that we've all spent more time thinking and we all spent more time thinking and talking about last year than we wish we had, just because it was such a thing. It's very important that, yes, unemployment remains very low, which pertains to what the Fed will do. But it's very important that wage increases are abating. If wages had continued to inflate, that is an incredibly strong driver of inflation, which would have been a bad thing, right? Because if inflation starts to tick up again, then we get more rate hikes, and then we do get into an almost guaranteed hard landing. At this point, we're seeing wage increases come down. So that means companies are finding it possible to hire workers without paying more. If you're not paying more, there's not more money floating around. We're not fueling the inflation engine the way that we don't want to. If China reopening, we shall see how much gusto Beijing gives that reopening, probably some. At the end of the day, it can't be a bad thing, right? It's got to help growth globally for China to be in the game again. And we were super lucky with the weather in Europe. The fact that we did not have a catastrophic energy crisis in Europe so far this winter has been, really lucky. That could have tipped the global setup over into a much more negative situation. And instead the euro's doing really well, which is another benefit for gold because that's one of the key reasons the dollar's coming down. The energy crisis that didn't happen means that inflation is coming down in the Eurozone. The Euro is doing well. These things are all setting various forces back sort of in line instead of being all over the place. And, again, when I talk about the hard data is really pointing in one direction, a bunch of the soft data is pointing in another direction, like air traffic or restaurant traffic. Like they're all doing just fine, thank you. So there's lots of questions yet to be answered about this recession, but every day I get a little bit more hopeful, maybe at some point verging into confident. I'm not quite there yet, that this will be more of the soft than the hard version of the recession. And that matters, right? Because base metals are a growth investment. Investors generally don't buy don't buy metals until they think we are in a growth environment. Recessions are not growth environments, so we need the recession to hurry up and get over with before the base metals question or the base metals bull market can have a chance of really getting going. Gold gets going earlier than that, but it still will be helpful if we do not have a severe recession, for sure. I do want to note that I don't think we're about to get a pivot of any sort. This is almost feels like a bit of a dated conversation now because there's been so much talk about pivoting in the last 6 or 8 months. I don't think the Fed is going to start cutting rates anytime soon. I just wanted to put that out there. The Fed has made very clear in their messaging that they don't want to repeat the 70s where we ended up with repeated peaks of inflation. And so they don't want to cut rates too early. And I think that at this point makes sense. And so I wanted to point that out. I don't think it certainly won't be a surprise to anybody in this room to note that in the midst of all of this, despite this recession question overhang, gold is kicking butt right now. So what's that about? I noted that this is the most predicted recession ever and that markets are forward-looking. Those forward-looking markets priced in the recession through 2022. I don't mean to put that in the past tense as if to suggest that it's all done because we don't know how severe the recession is or will be. Therefore, the details are yet to play out. But a big part of the pricing in of the recession happened when the S&P lost 20% last year. That matters because gold is considered a hedge in bad times. But the details of that hedge action are important. Gold does not outperform in the first part of a stock market crash or downturn, whatever word you want to use. It falls alongside everybody else because everybody's just selling whatever's liquid, and that includes gold. But it does outperform in the second half. It bounces before other asset classes, and it usually rises quite strongly. And it's a bit of a self-fulfilling prophecy because this is what it does, and so people buy it because it does that. It doesn't matter really why. That is what happens. Gold bounces early and then outperforms other asset classes in the second half of a recession. I think one of the key reasons that gold has been moving since November is because those who are considering the macro picture see that we're in the second half. We already had the first half in 2022. That's when the S&P lost 20%. Again, I'm not saying that gold is only going to go up from here. Nothing ever goes straight up. And even as gold rises up out of a bottom, leading other asset classes, it will do it in fits and starts, right? But I do think that we are in that second half of the crash, correction, choose your word, moment. And that is a key reason why gold is moving up. It certainly helps that the US dollar is no longer rising, and that's the euro being strong largely. So that's really helpful. It also helps that the Fed funds rate has topped, so nobody's expecting real rates to rise significantly from here. We got through that. And it's very notable, by the way, that gold held its ground last year despite the US dollar rising as much as it did and real rates rising as much as they did. It's very notable that gold ended the year flat despite those headwinds. So it did better than you would have expected. It wasn't exciting for anybody's portfolio returns because zero is zero, even if, anyways, it's better than negative, but it's still zero, so it doesn't really help. But it is notable, so it sort of set it up well to lift off once there was any interest. And I do think that forward-looking macro investors decided that a bunch of the crash or correction had already happened and that gold's time as a hedge has arrived. And that's a big reason why it started to rise. Now, this is a chart that compares gold miners as per the GDXJ to the price of gold. And it's there to suggest the kind of upside that remains if you think that gold is going to perform in the kind of way that it did in the last bull market. I don't know if that's what's going to happen. I mean, I wish I had a crystal ball. I don't know. But I put it up there as a way of emphasizing that, yes, the largest gold stocks have already moved up nicely with the gain in the gold price, which is good. You don't want the gold price to move and for stocks to not follow it at all, because that suggests a lack of confidence. Miners have absolutely moved. We've had some really nice returns in miners, but there's a lot of the market, of the gold equities market, that hasn't enjoyed much lift yet. And so I think that there's still a lot of room left to run in this space. There's a lot of room for breadth for the rest of the stocks in the space to attract attention. And there's just straight up a lot of room for equities to attract more attention, because I think gold has moved first and we haven't had as much performance in the stocks relative to the price of gold as we will once this market is more established and there's more of a generalist following and there's just more conviction, which I think will come. Okay, so that's one metal. I've spent all that time talking about only one metal. What about all the rest of them? Well, gold, I think, I've talked about the where and why gold is moving in the moment of this metals market. I think for all of the industrial metals, the recession question is more of an overhang. And that is, as I said before, because industrial commodities are an industrial investment, right? And so people don't buy growth like that. They don't buy industry until they believe that there is growth coming for industry. And when every financial writer of any sort is talking about recession, guess what? Growth isn't the first thing that people think about. And that's fine. That's where we are in this moment. But once we get through this, whatever the details of this turn out to be, there's lots in this hall at this show who have spoken to the very strong supply-demand fundamentals for quite a few of these industrial metals. I mean, my favorites are certainly copper and silver. I think that the supply gaps there are unreal. I think that the fact that they can't be replaced for their key applications is very important. And so I think that as soon as investors, the generalist investor, starts to think that the worst is over, have some confidence that the worst is over, and starts looking ahead at growth, well, what do people want to ride out of recessions? They want to ride real assets that have strong fundamentals. I can't think of, there's not going to be a lot of things that shine brighter in that context than the absolutely irreplaceable commodity that is needed for everything to do with the green transition. That's a reality, which is copper, and silver, which is just dramatically undersupplied. You've probably heard this. At this point, silver, solar panels use up about 11% of the world's silver, and on an annual basis. The solar installations are expected to increase 9-fold by 2030. So that basic math suggests that by 2030, solar panels should use all of the world's silver. But it turns out there's a bunch of other people who need silver for things. So there just isn't enough silver as solar panels expand. That doesn't even take into account the fact that they're starting to increase the loadings of silver on silver panels. That's like the next thing. Anyways, once we get out of this, I think that these metals are going to shine strongly because they are precisely the kinds of metals or the kinds of assets that investors want to ride out of a recession. And this slide is a bit of a summary of that, right? Metals are a value play. They are real assets, and the fact that they're real assets matters as we all wrap our heads around the fact that the broad investing landscape has changed. We had over a decade of highly speculative FOMO investing where big tech, small tech, unicorn tech, led the way, and everybody piled into that. And that's fine. That was a result of those fiscal and monetary conditions. It just was very much like the tech bubble. That bubble has popped again because we are in a different interest rate environment, and we've moved into an environment where real assets and and value, I said the wrong word, value stocks will matter instead of growth stocks. And so real assets, companies that make money, companies that don't have debt, companies where there's a fundamental rationale make a lot of sense, and metals absolutely fit that bill. I'm going to quickly go through some categories of kinds of stocks that I like at this metals moment, and I have an example or two of each included, so to just make it a bit more tangible. Certainly miners. I mean, I've talked about how excited in the very near term I am for gold, and as soon as the recession is over time frame for copper and silver. I also like uranium. I also like lithium. And miners are obviously the most guaranteed exposure to a rising metal price, right? If you can find a mining company that has a re-rating event on the horizon, well, that's a bonus. So Orezone is a good example of that. It built its mine. It hasn't yet been re-rated for that mine being a functional success, which I very much think it will be. And so that is the kind of asset that can work. Capstone, much larger entity, large producing miner, exposure to copper, but there's a bit of an overhang on the stock because they're building this big mine. So these are the kinds of re-rating events that can add a little upside to what is otherwise just straight up, reasonably guaranteed exposure to a rising metals price. Okay, so advanced projects of scale. It costs a lot of money to move a project towards development, right? And so investor malaise in 2022 means that there was a lot of advanced projects of scale that just got ignored all of last year, and I think are very undervalued relative to their to metals. Sigma Lithium is building a mine. I mean, the lithium market is insanely tight. It actually doesn't matter what you think will happen to the price of lithium. There's just no assets in the pipeline. They're about to finish building this mine. It can be expanded dramatically. It's a very low-cost capex. Troilus is another example. It's a little earlier stage. They're certainly not building it, but they're about to publish a feasibility study. Big asset, permittable, good jurisdiction. Didn't get much traction in 2022 because there weren't enough investors who cared about the space. So advanced projects of scale, I think, are another good consideration. Similar, but moving down the food chain a bit, so to speak, is under-recognized discoveries or under-recognized developing resources. Again, this is just about the fact that there wasn't enough investor capital inflowing into our space in 2022. There are a bunch of companies out there that did some great work, made some discoveries, or really demonstrated that their discovery had the potential to turn into a significant asset. It didn't really get much love for it. So I think Vizsla is probably a very familiar name to a lot of you. Their share price does not look exciting right now, but their asset looks very exciting to me, especially for anybody who thinks silver is set up well, and I have certainly made clear that I am in that camp. It turns out I have another silver one here, Silver Tiger, also done a lot of great work at their El Tigre project in Mexico over the last year to demonstrate scale, grade, mineability, and hasn't gotten a lot of love for it. So I think those are two good examples of that. Then there's also the companies that use the downturn specifically, like took advantage of it in a very specific way. Not doing work like the, drilling and discovering the work that's expected, but something a little bit unexpected. So use the downturn to position for growth or to put themselves in a position to be worth a bunch more. So Montage, I think, is a very good example of that. Their Kone asset in Côte d'Ivoire, already feasibility stage, good-looking mine, not super high grade, but good-looking, economic, simple, made sense. Then they made a deal for the surrounding land package that has all kinds of data, tons of low-hanging fruit, and ripe with opportunity to make high-grade discoveries that can amplify that mine. And I don't think the market paid much attention to it. So I think that's a really interesting story. Heliostar almost gave up on exploring their assets because they realized how little recognition that exploration was getting. So they bought some assets. That stock's not even trading yet from that transaction. But I think that's another example of having used the downturn to position for growth. And then always explorers. Explorers, I have to emphasize, very high risk, but when they work, man, do they work. Max Resources, if you want if you want a copper explorer with the potential to explode in price, Max is there. I am not making any guarantees there, but there's potential for an explosion of price in Max. And Sterling Metals, similar, the potential to explode with a silver discovery. My parting words are to just stay focused, have a plan, know what you want to do, know that it's not going to be smooth sailing until the recession question is answered, but have conviction in what you think the various metals will do, and decide on your balance between juniors and bigger stocks, what metals you want to emphasize in your portfolio, whether you plan to take profits seasonally or just ride through this market. And as always, have a thesis for each stock that you own so that you can reassess with rationale. Thanks so much.